One of the most important issues in investing is the concept of an investment policy or an investment policy statement. Unfortunately, most investment textbooks tend to ignore the investment policy statement. The ones that do include investment policy statements tend to be written by chartered financial analysts. Why? Because the CFA Institute places great importance on constructing investment policy statements. If you ever take the CFA program, you'll find in the Level III exam, you'll write a great many investment policy statements. And the reason investment policy is so important is that before we can determine what are the appropriate investments for an individual, we need to know something about the individual. Some of the things that can help us to determine an appropriate investment strategy are things like time horizon, risk tolerance, the individual's tax situation, their income needs, their return objectives. What the investment policy statement does is it serves several purposes. First, it serves as a sort of roadmap for the investor. Okay, where are we today and where would we like to wind up? If you don't have a plan, if you don't have a map, it's hard to get to where you'd like to be. In some ways, you'll find that the investment policy statement is a little bit like a doctor's preliminary questions before she starts the examination. If you've ever gone to a new doctor, they always ask you a lot of questions about your family history. Is there a family history of heart disease? Is there a family history of cancer? That helps them to determine what tests they should give you. That helps them to determine what specific things they should be looking for. Okay, there's certain tests that you might give to somebody when they're 50 years old, but if there's a family history of this type of disease, you might take the test when you're 30 or 40 years old. Okay, it helps them to determine what's the appropriate course of action. They may ask you if you smoke, if you drink. Okay, a lot of information that can help them to prescribe the right course of action. And finally, the investment policy statement is a contract. It's a contract between the investment advisor and the client. You've sat down, you've determined what the goals are, so that, from the investment advisor's point of view, it provides some protection. If the client comes back and says, well, my investment advisor took too much risk, we can go to the investment policy statement. We can see that the client has signed off on it and said, I'm willing to accept these risks because I'm 30 years old, I'm young, and I'm willing to take those risks. For the client, again, it serves as a way to judge what the investment advisor has done. If you go in and you've said, I want to take moderate or low amounts of risk, and your investment advisor has put you in high-risk securities, again, you have a contract that says that the investments that your advisor came up with were inappropriate. All right, so the way the CFA Institute does it is that they look at return objectives, risk tolerance, time horizon, taxes, liquidity, and any legal considerations. You'll find that other investment policy statements cover most of these slightly differently, perhaps, and you can actually search out on the internet investment policy statements, and you'll find them for charitable organizations. If you're thinking of donating to a charity, you might want to know, what is their investment policy? What kind of risks are they taking? How are they using the money? So this can be valuable for a lot of people, not just the people involved in investing. So let's take a little more specific look at some of these factors. Okay, return objectives. You want to be specific. Return objectives like, I want to make as much money as possible, aren't very helpful for the investment advisor. In fact, they may be detrimental because that person may wind up choosing high-risk securities for the individual just because that person wants to get the best return when they don't really or shouldn't be taking that much risk. So things like, I'd like to have $100,000 a year in retirement with that amount growing at the rate of inflation is a much better return objective, because it's much easier for the investment advisor to prepare a plan that can generate that income and that growth in the to keep up with inflation. Risk tolerance. Nobody likes risk. Okay, most of us are risk averse. But what factors determine how much risk we can tolerate? Well, part of it's a psychological makeup. Some people just don't like risk. If they find out that their portfolio lost $10, they can't sleep at night. Okay? Those are people who need to have very safe securities, a very safe portfolio. But factors such as your age. If you're very young, you have some time to catch up if the market's gone down. Okay? What's your income? If you have a good, solid income, then you don't need to live off of your investment portfolio, then you can afford to take more risk. If you have a great amount of wealth, you can take more risk. Okay? What are your liquidity needs? That is, how soon do you need to get your money, and also time horizon. Those pop up also in the investment policy statement, so we'll discuss those next. Okay? Time horizon. When do you need your money? If you need your money tomorrow, you have to take a very conservative investment approach. If you have a longer horizon, you can be more aggressive. You can invest in longer term assets such as stocks. Okay? A person may have a number of time horizons. Okay? Some short-term goals for things such as buying a car, okay, or an intermediate goal of financing your child's education, and then a longer term goal such as financing retirement. So you may have a number of time horizons, and how we invest the proceeds for each one of those accounts will depend on the time horizon for each one. Okay, taxes. Taxes are an important part of determining suitable investments. Someone who's a wealthy individual who's in a high tax bracket may benefit from tax-free bonds. They may benefit from buying stocks that pay very little dividends but a lot of capital gains, because if you don't sell the stock, you don't have to pay the tax. Okay, liquidity. When do you need your money? If you need it soon, you need liquid assets. That is, assets that can be easily converted to cash at a fair price. Something like a treasury bill or a money market account or a bank savings account tend to be very liquid. You can go into the bank, get your money out, no problem. Okay, no loss. But if you happen to have a house is not a very liquid asset. If you want to sell your house tomorrow, you may have to sell it at a loss. So that's not a very liquid asset. So that's an issue too. If you don't have any great liquidity needs because you have a good income and you don't have a great many expenses, then you can be more aggressive with your investing. And legal considerations. There are a number of legal considerations that you have to think about as an investor. As an individual, obviously you need to obey the law. You need to avoid things like insider trading. But you also need to know things like, how much can I contribute to my retirement account? What's the maximum? You also need to know how much I need to withdraw from my retirement account if I happen to be age 70 and a half, because if I don't take out enough, there's a penalty. So let's take a quick look at a couple of examples here. I'm sorry, let's one more thing here for the legal considerations. If you happen to have a charity or a foundation, there may be a legal charter that has to be followed. For an individual, you just need to obey the law. But for a charity, they may have a charter that specifies how the money is spent, what portion can be spent, and you have to follow that when setting up the investment portfolio. Okay, let's take a look at a couple of different cases here. Okay, the Rich family, Dr. and Mrs. Rich, both 35 years old. okay, have a combined income of $500,000. They're professionals, they don't have any children, they're not planning to have children, they're in the 40% tax bracket, and so they're in a high tax bracket. Mrs. Rich has just inherited $1 million. The two of them don't expect to use the principal or the income from this account until they retire at age 65, and any money that's left over after their death goes to a place called Life Ministries. And let's look at Life Ministries. Here we have a tax-exempt charitable organization, and it has a charter, and the charter requires that all income earned from the endowment must be used in operations. Any increase in the value of the principal of the endowment must, whether it's realized or not, that is, whether the stocks are sold or not, must remain in the endowment. So they need $125,000 a year in income to fund their operations, and they happen to have a $2.5 million endowment portfolio. So let's take a look at their circumstances. Now, I've sort of abbreviated things here. You should be more specific when you create an investment policy statement. But the Foote family, what's their return objective? They can seek high returns. Why? Because they can tolerate a lot of risk. If you want higher returns, you have to take more risk. They have a very good income. They're not expecting to need any of the money that Mrs. Foote has inherited. Their risk tolerance is high. Again, they have a good income. We don't have a lot of information about them, but you get the feeling that they don't have any great liquidity needs. So because of their large income, so they can take a lot of risk. Okay, they can invest in a lot of stocks, perhaps some growth stocks, which will likely have a better return over the longer run. They have a long time horizon. At age 35, they're not retiring for 30 years, which is a long time. And they may live another 25 or 30 years after they retire. So they may have another 60 years of investing. So that's a very long time horizon. Oftentimes people make the mistake of thinking that I'll be retiring in 10 years. I have a short or modest time horizon. When you'll be retiring at 55, you may live 40 more years. You may have a 50-year time horizon. Taxes are important. We need to take that into consideration because they're in a very high tax bracket. Because they have such a good income, it seems that they have small liquidity needs. If their car breaks down, they should be able to get it repaired or replaced with that $500,000 income. And any legal considerations, they just need to obey the law. Okay, know how much they can put in. You know, they don't want to get penalized for putting too much into their retirement account. Obviously, they don't want to engage in insider trading, etc. In the case of Life Ministries, what's their return objective? This is a lot more specific. They need to generate $125,000 in income every year, and we want it to appreciate enough to offset the rate of inflation. Their risk tolerance is moderate because they have a long time horizon. Okay, charities can stick around for many, many years. Okay, the Red Cross, the United Way, many of these charities have been around for decades. Okay, sometimes 100 years or more. So they have a long time horizon. They're tax exempt, so things like tax exempt bonds are not appropriate for them. Liquidity, it doesn't seem to be a major factor. They just need to generate this $125,000. And legal considerations, they need to follow the charter requirements that say that they have to spend any income they generate. So any interest or dividends they receive, they have to spend, but any growth that they get, that is any increase in the value of the principal, that is if the stock's price goes up, whether they sell the stock or not, that has to stay in the endowment. So you can see that both of these circumstances, okay, or both of these portfolios, the one for Life Ministries and the one for the Rich family, are going to be different. Their investment policies are going to be different, and their investments are going to be different. So it's important that you understand that before you construct their portfolios.